Okay, let's unpack this Castor Maritime. CTRM. You see these crazy low numbers, right?
Yeah, straight away.
A PE well under 1, price to book barely above 0. And, your value investing senses just start tingling.
Totally. It looks like one of those hidden gems, potentially, like finding something amazing at a flea market.
Exactly. But then, reality hits. You see all the negative buzz around it. Deep skepticism.
Mm-hmm. A lot of negative sentiment.
So the big question, is this the bargain everyone's missing? Or is it just a classic value trap? Shiny on the outside, but rotten underneath.
That's the core puzzle, isn't it? And that's what we're digging into today.
Yep, and luckily you shared this really detailed source, the deep research report, Castor Maritime Inc., CTRM, a value investing analysis as of April 15th, 2025. So let's see what's really going on here.
What's fascinating right off the bat is that huge mismatch. Rock bottom valuation versus the market basically screaming something's wrong.
Absolutely. So our goal here is to understand why. What's behind that disconnect?
Exactly. What are the fundamentals telling us?
Okay, context first. Castor Maritime Global Shipping Company. But they made a pretty big pivot recently, acquiring a controlling stake in MPC Capital.
Right, MPC. That's a Frankfurt-listed asset manager. Pretty substantial, too.
Yeah, around $4.8 billion under management, focused on maritime, especially container ships through MPC container ships, and also renewable energy infrastructure.
So a big move into a different kind of business.
Definitely. So today, we're looking at CTRM through that value investing lens, the business itself, who's running it, the financials, market view, ownership, risks, especially with those new 2025 U.S. tariffs in the mix.
Our mission really is to cut through all that noise, those tempting low ratios, and pull out the key insights from this research, what really matters here.
And for you listening, this deep dive, it's designed to give you a clear picture of all the complexities. We need to go beyond those surface numbers.
Uncover what a discerning investor would really need to think about.
All right, let's kick off with Chapter 1 in the report, Understanding the Business. Historically, Castor was all about dry bulk shipping.
The workhorses of the sea, yeah. Moving iron ore, coal, grains.
Exactly. Revenue mostly from time charters, basically renting out their ships for set periods. Pretty standard stuff.
And, as you know, super cyclical. Goes up and down with global trade.
For sure. But then, boom, December 2024. They acquire that 74.09% stake in MPC Capital.
That's the game changer, potentially.
It is. MPC, as we said, Frankfurt-based investment and asset manager, big in maritime, container ships via MPC container ships, renewables too. Almost 5 billion AUM. It's a significant operation.
And the thinking behind it, according to the report.
Diversification. Get into more stable fee-based income streams, less reliance on the shipping roller coaster, plus tap into energy infrastructure and leverage MPC's platforms.
Makes sense on paper. Diversify away from pure shipping volatility.
It does sound logical, but, the big question is always integration. How well do these two different businesses actually fit together?
Exactly. Will they get those synergies they're hoping for? Or just be two separate things under one roof? That's the risk.
That is the big question. Now, the report also talks about CTRM's own fleet. It's been changing a lot.
Right. They spun off the tankers into Toro Corp back in 2023.
Yep. And then they sold off a bunch of dry bulk and container ships through 2023 and early 2025. Pretty aggressive selling.
So the owned fleet got smaller.
Much smaller. The analysis around April 15th, 2025 figures about 11 vessels left. And 2 of those, the Gabriella A and Magic Callisto, were already lined up to be sold.
So maybe only 9 ships actually operating, mostly dry bulk?
Looks like it. And the report's clear. This makes CTRM a much smaller player in physical shipping now.
Which really highlights that strategic shift towards MPC Capital, doesn't it? Less ship operator, more holding company.
Exactly. Moving away from earning the steel towards managing assets, potentially generating fees.
But again, it all comes down to how well they manage and grow that MPC side. That's the future, apparently.
Okay, let's zoom out. The dry bulk market itself. The report says it's highly cyclical, intensely competitive, needs huge amounts of capital, standard stuff for shipping.
And it mentions recent disruptions. Red Sea, Panama Canal.
Yeah, temporary impacts. But the bigger picture, looking at 2025, 2026, analysts like BIMCO are saying ship supply growth might actually outpace demand growth.
Uh-oh. That usually means pressure on freight rates, right? Bad news for ship owners.
Generally, yeah. Create a tougher environment. Plus, the report flags some potential headwinds for demand.
Like what?
China's growth may be moderating, global coal trade, Long-term, expected to peak or decline with the energy transition. Even more steel recycling could hit iron ore demand eventually.
So key drivers might be weakening.
And the Baltic Dry Index, that key rate benchmark,
Yeah.
showing a weaker trend lately. So their traditional business isn't exactly sailing with a strong tailwind.
And regulations aren't helping either a bit.
No kidding. You've got the IMO rules, EHI, CII, already in effect since Jan 23, making things more complex, more costly.
Pushing for efficiency, reducing carbon.
Right. And then there's the IMO 2027 net zero framework coming up, approved this April. That likely means even bigger changes.
Slower speeds, maybe? Retiring older ships faster?
Could be. Plus, huge investments needed for alternative fuels. LNG, methanol, ammonia. It's getting complicated. And the EU ETS adds another layer for ships going to Europe.
Wow. So just operating ships is getting way more expensive and complex.
Seems like it.
Yeah.
Which brings us to the crucial question for value folks. Does Castor have any kind of competitive advantage? A moat.
In that core, dry bulk business.
Yeah. And the report's assessment. Not really encouraging. No brand strength charterers, just want the right ship at the right price.
And they're small compared to the giants, so no economies of scale.
Right. Standard vessel types, nothing unique. And charterers can easily switch to a competitor. So the conclusion is basically no discernible moat in their traditional shipping ops.
Which makes sense in a commodity business like dry bulk. Tough to build a lasting edge.
Now, the report does mention that MPC Capital, the asset manager, could potentially build a moat through scale, recurring fees, expertise.
Potential, though. Not proven yet.
It's exactly.
Yeah.
It's early days, lots of integration risks still. So maybe a moat possibility on the MPC side, but definitely not guaranteed. Building that takes time, execution.
And this acquisition is still pretty fresh. We need to see how it actually plays out. The synergies are just hopes right now.
Okay, let's steer into Chapter 2, Management Evaluation. This is where things get, well, a bit more complicated.
Uh-huh. Often the case.
Leadership is very centralized around Petros Panagiotis, founder, chairman, CEO, and CFO since 2017.
Wearing a lot of hats.
He guided the NASDAQ listing in 19, oversaw that big fleet expansion in 21, funded mostly by issuing shares, by the way.
Ah, dilution. Okay.
And the Toro Court spinoff, where he's also CEO, lots of vessel sales, many to related parties apparently, and now the MPC deal.
And those reverse splits?
Can't forget those. 2 1-for-10 reverse splits, May 21, March 24.
Not usually a great sign. Multiple reverse splits. Often signals a struggling stock price. That level of control is also something investors watch closely.
Very closely. Now, the board has non-exec directors, like the audit chair, Angelos Runic-Platanius, but the report flags frequent related party deals.
Which raises questions about oversight, right? How independent is the board, really?
Exactly. And Panagiotis having key roles at Toro Corp and Icon Energy Carriers, too, adds complexity, potential conflicts of interest.
Yeah, when one person leads multiple connected companies, it's hard to be sure decisions benefit all shareholders equally, especially minority ones.
Right. Now, communication. They do the standard SEC filings, press releases, but the report suggests maybe a lack of transparency.
On what specifically?
On the why behind the big share dilution and the terms of those related party deals. Makes it hard for regular shareholders to judge if things are really fair.
Yeah, clear communication is key for trust. If big moves aren't explained well, it erodes that trust fast.
Which leads right into ethical reputation. The report uses the word tarnished. Ouch.
Doesn't hold back then. Why tarnished?
Main reasons cited. Massive share dilution at low prices. Those multiple reverse splits. And a pattern of selling assets to family-connected entities. Plus, related party financing deals.
Okay, that's a concerning pattern.
Plus, it mentions Panagiotis has locked up voting control to preferred shares, basically disenfranchising common stockholders. And poor corporate governance rankings mentioned too.
Wow. That's a lot of red flags for anyone focused on governance and management integrity. Value investors really care about that stuff.
They do. Actions that seem to benefit insiders over common shareholders. Major warning sign. Questions about trustworthiness.
Definitely raises serious doubts.
So when the report assesses management's shareholder orientation, it says, okay, they can execute deals, clearly they're active, but alignment with common shareholders, deeply questionable.
That's a strong statement.
Yeah. The history of dilution, related party stuff, it suggests maximizing value for the average Joe stockholder hasn't been the main goal. That misalignment is a huge worry for long-term investors.
Absolutely. You need to feel management is on your side. Those actions really undermine that confidence.
Okay, let's dive into Chapter 3, Financial Health. the numbers bit. The report gives a snapshot around April 15, 2025.
What are the headlines?
Market cap around $20 million. Stock price 2.08. And here's where it gets wild.
Yeah.
PE ratio between 0.3 and 0.6.
Whoa, seriously low, based on what earnings?
Trailing 12 months EPS estimated between $3.72 and $7.20. And the price to book, about 0.04, tiny.
Okay, those numbers screen cheap, but what's the catch?
Well, revenue growth over the last year was negative. Net margin, though, was super high, 96%.
90%? How?
The report immediately flags it, likely inflated by gains from selling ships, not core operational profit.
Right. Those super low multiples often reflect skepticism about sustainable earnings, especially when asset sales are involved.
Exactly. Now, debt-to-equity ratio, really low, 0.3%. They paid down debt.
That's a positive. Low debt is good.
Free cash flow for the last year was positive, too, about $5.9 million, but historically volatile. And return on invested capital, estimated low single digits.
So statistically cheap, low debt, but maybe not great underlying profitability or consistency.
That's the paradox. Low debt is good, but volatile earnings and low ROIC suggest the core operations haven't been consistently strong earners.
Okay, what about overall financial stability?
Report highlights big swings in earnings, net income jumps around a lot, and again, recent profits boosted by those vessel sales.
Any dividends?
Nope, no common stock dividends. They did cut debt a lot in Q3 2024, but then took on a new $100 million loan and issued $50 million preferred shares to Toro Corp to fund the MPC deal.
So debt came down, but then went back up a bit for the acquisition.
Sort of, yeah, through different means. And their current ratio short-term liquidity is super high, like 30x, mostly because of cash from issuing stock and selling assets.
30 times. That is high. Too high, maybe.
The report suggests it might actually signal inefficient capital deployment, like cash just sitting there, not earning returns.
Right. Cash on the sidelines isn't helping shareholders much if it's not reinvested well.
Exactly. Finally, Chapter 3 looks at historical trends 2019 to Q3 2024. And the picture, volatility.
Big swings.
Yeah, revenue shot up 2022 with fleet expansion, then dropped in 23 and TTM as they sold ships. Net income all over the place, big profits in 22-23, likely juiced by asset sales.
And earnings per share.
Super erratic, mainly because the share count changed so much with all the equity issuance. Total assets grew, then shrank. Debt equity fluctuated but is low now. ROIC consistently pretty low.
So capital invested hasn't generated great returns consistently.
Seems that way. And free cash flow was negative during expansion. Positive recently, again, probably helped by asset sales. So the history doesn't show steady, strong performance from core ops.
Really makes it tough to gauge the true underlying earnings power, doesn't it? All that volatility and the asset sale noise, hard to project the future from that past.
Definitely. Okay, before we jump into the second half, just a quick word from our sponsor.
Are you spending hours sifting through financial reports and news articles, trying to get the edge in the market? StockAnalytics.ai is your AI-powered research assistant, designed to give you in-depth analysis and actionable insights in seconds. Simply input a stock ticker, and our cutting-edge algorithms will analyze financial data, news sentiment, and historical trends, delivering comprehensive reports right to your fingertips. Stop guessing and start knowing. Visit StockAnalytics.ai today for a free trial and experience the future of investment research. That's StockAnalytics.ai.
Welcome back to the deep dive. We're digging into Castor Maritime, CTRM. Second half now, starting with Chapter 4, Market Sentiment.
And how's the market feeling about CTRM?
Not great, apparently. The report says perception is overwhelmingly negative.
Driven by?
Mostly the history, it seems. Dilution, reverse splits, those governance concerns we talked about, less about recent financials or even the potential of the MPC deal.
Interesting. Past actions overshadowing current stats.
Yeah. And apparently almost no analyst coverage, which isn't usually a sign of confidence.
No, lack of coverage often means the institutional crowd is staying away, something for individual investors to note.
News flow tends to focus on vessel sales, especially related party ones, the MPC deal financing, past splits, NASDAQ compliance issues.
The usual suspects for a company with this history.
Right. And lots of online chatter about governance, speculation, even calling it a meme stock.
The meme stock label. Often means trading is driven by hype, not fundamentals.
And those super low valuation multiples, we keep mentioning PE under 0.6, PB 0.04, they really just scream deep market skepticism, pricing in a lot of risk.
The market's basically saying, we don't believe those numbers are sustainable or real.
Okay, trading dynamics, also interesting. Report flags high short interest metrics.
People betting against the stock.
Yeah, off-exchange short volume often over 40–50%. Might not be a huge absolute number of shares shorted, but relative to the float in volume, it shows significant bearishness.
And is it expensive to short?
Nope. Low cost to borrow. Means plenty of shares available for short sellers. Options market shows high uncertainty too, implied volatility over 100%. Market expects big swings.
High vol. Okay. What about puts and calls?
Put-call open interest ratio is low, which seems odd given the negativity. But the report says don't read too much into that. Could be other factors.
Right. Options data can be tricky.
Also mentions periodic spikes and fails to deliver, sometimes linked to shorting, but again, caution needed. And technical analysis shows a falling trend.
So overall, lots of disagreement, but the dominant mood seems to be downside risk is high.
Pretty much. Many market players seem to think it's heading lower.
Okay, Chapter 5 then, ownership structure. This ties back to governance, right?
Directly.
Right.
Report reiterates highly concentrated ownership. Petros Panagiotis controls things through preferred shares.
Which one specifically?
Mentions Series B preferred, giving him historically like 93% of the voting rights. Plus, maybe more influence via Toro Cor's Series D preferreds.
Wow, 93% voting control. That leaves common shareholders with basically no say. Huge risk for minority investors.
Huge risk. And very little institutional ownership in the common stock, as we said. Another red flag for due diligence.
Institutions often avoid companies with structures like that.
Plus, transparency issues. Because it's a foreign private issuer, FPI, insiders don't have to file Form 4s when they trade the stock.
Meaning we don't easily know if insiders are buying or selling their own shares.
Exactly. Much harder to track. Which just adds to the governance worries. Makes it tough for outsiders to know if management's interests are aligned with theirs.
That lack of transparency is a big deal, especially with the other governance flags.
All right, Chapter 6, Risk Assessment. SWOT analysis time. Strengths first.
What are the positives listed?
Diversified model now with MPC. Significant cash pile, low reported debt, experience in buying selling ships, access to MPC's platform, some modern vessels in the fleet.
Okay, some points in their favor, but need to weigh them against the weaknesses.
Absolutely, which the report lists as poor governance track record, weak core earnings quality, no real competitive moat in shipping, small scale in shipping, high dependence on cyclical markets, and that negative market sentiment.
Yeah, those weaknesses hit on all the major concerns we've discussed. Governance, lack of moat.
Then opportunities.
Yeah.
Potential ways things could go right.
Such as?
Leveraging the MPC platform, catching a good shipping cycle upturn, deploying that cash well, industry consolidation, asset play opportunities, maybe more ship scrapping due to regulations.
Potential upside, but depends on execution and external factors, obviously.
Definitely. And finally, threats, significant risks.
Let's hear them.
Shipping market downturn, MPC integration failing, regulatory cost constraints like IMO 2027, geopolitical instability messing with trade, U.S. tariff impacts, financing risks from the MPC deal or rising rates, continued governance concerns, and even NASDAQ delisting risk if the price stays low.
That's a pretty substantial list of threats. Governance keeps popping up as a major one.
It does. It casts a shadow. The report sums up the risks across market, operations, finance, regulation, and especially governance. Big uncertainty about sustainable earnings, potential for more dilution, and that fundamental misalignment of interest due to the governance setup.
So the core message on risk.
The low valuation might just be a value trap. Looks cheap, but the risks might fully justify that low price or even mean more downside.
The classic value trap scenario. Is a low price a bargain or just a reflection of deep problems?
Crucial question. So we land at Chapter 7, the conclusion of this deep dive based on the report. Key findings summarized. Statistically cheap, yes, but big qualitative concerns.
Governance, lack of moat, uncertainty around MPC.
Exactly. Significant risks that seem to outweigh the potential rewards for a value investor. Now, as we wrap up, here's that final thought for the listener.
The end hook tease.
Right. Given all these complexities, all these red flags, what's the one unexpected thing, the black swan, that could totally change the story for Castor Maritime?
Something beyond the balance sheet or normal shipping stuff.
That's the hint from the report. Something outside the usual metrics. We'll reveal that right at the very end.
Okay. Looking beyond the obvious potential game changers.
So, to briefly bring it all together on Castor Maritime. Those low valuations look tempting, don't they?
Initially, yeah.
But the weight of the evidence, especially those major governance risks, it paints a picture of a highly speculative situation.
Not your typical safe value play.
Not at all. The lack of a strong moat in shipping, the unproven benefits of the MPC deal, plus that concerning management track record. It should give any value investor serious pause. Warrants extreme caution.
Key takeaway then. Statistically cheap doesn't automatically mean good value. You have to look at the qualitative risks.
Especially when they're this significant. Okay, now for that end hook reveal. What unexpected factor could flip the script for CTRM? Let's hear it. According to the report, it could be one of two highly speculative things. First, a massive unforeseen geopolitical shift. Something that totally redraws global trade maps in a way that just happens to perfectly benefit CTRM's specific fleet and new diversified structure.
Like a huge, unpredictable change in shipping routes or demand.
Exactly. The second scenario, a radical, credible overhaul of their corporate governance. A complete turnaround that genuinely convinces the market they're now serious about common shareholder value.
A genuine commitment, proven by actions.
Right. But the report stresses both are super low probability, high impact, black swan type events, not things you'd base a normal investment thesis on.
Very hard, if not impossible to predict. Highly speculative scenarios.
If you found this deep dive helpful and want more analysis like this, definitely subscribe to Stock Analytics AI's YouTube channel. We try to give you the insights to navigate these complex investment situations.
We aim to provide the tools and knowledge for tackling the complex world of investing.
And finally, the important bit. This analysis was based on the research report provided, dated April 15, 2025. It is absolutely not financial advice.
Please remember, even sophisticated AI analysis has limits.
You absolutely must do your own thorough research and due diligence before making any investment decisions. Thanks for joining us for this deep dive.